Mike Bruce here, founder and chief investment officer of Scale Investment Group, a boutique investment management firm in Southeast Michigan, right about there. A friend of mine recently asked me my thoughts on investing, whether or not they should put money in now or whether they should wait until after the election when things settle down. And I use air quotes there because things are never really settled down in the markets. There's always something going on. But my answer, in short, to them was, well, it depends. It depends on a lot of factors. First factor that I would ask is, what is it that you're investing in? If you're investing in fixed income securities, so think things like money markets, CDs, bonds, then I would say invest right now. Don't even wait until tomorrow. Invest right away, assuming that it's the right type of investment for you. And the reason I say that is because those investment vehicles, the majority of what you're going to get out of them in terms of earnings, or all of what you're going to get out of them in terms of earnings, if it's like CDs or money markets, they have fixed stable prices. So there's not going to be any price appreciation or depreciation, right? Bonds a little bit different. But the majority of what you're getting is going to be in interest payments. Why is that important? Well, who the president is, whether it's Republican or Democrat, male, female, black, white, whoever, it doesn't matter. It has a lot more to do with what the Fed's doing with interest rates rather than who's in the White House. So my answer there is, okay, that's a simple one, right? If you're investing in fixed securities, now is better than later, period. If you're investing in equities, it's a little bit more complicated. In fact, a lot more complicated. Let's say if you're planning to make a large lump sum investment in a particular company or a particular industry, it really matters what that company or what that industry is. If it's, let's say, kind of consumer discretionary goods or things that you kind of buy every day, they don't have like the hugest lobby in Washington. They don't get a lot of corporate welfare from DC, so it doesn't really matter, right? If you're investing in Procter and Gamble or something like that. But if you're thinking about investing in a company or an industry that historically gets a lot of money from the government, then it does matter, right? It does matter who's in office, and it does matter whether or not those handouts continue. For example, if you've got two candidates running for president and one of them wants to ban fracking, for example, well, you're not going to invest in a company that derives the majority of their revenue from fracking. Same goes for coal, same goes for whatever. Now, on the flip side, if one of the candidates wants to invest heavily in growing a particular industry, and the government has done this, you don't have to go back too far to see all kinds of incentives for electric cars, for renewable energy, solar, wind, that kind of thing. Uh, well, then that matters too, right? And that could influence whether or not you buy now or buy later. Now, generally, I would think you'd want to wait until later to actually see that your preferred candidate does get in so that those companies do get that corporate welfare that you're counting on. Otherwise, you're running the risk that the other candidate gets in and that company goes belly up because they were already spending the money that they were expecting going forward. And you can base it on polling or betting markets or whatever all you want, but they've been inaccurate before. Remember, Hillary Clinton had a 99% chance to win the 2016 election, and that didn't quite work out. So there is precedent for that in the past. Another thing to consider is, particularly when you're looking at companies that are likely to get corporate welfare, is how much of that is already baked into the price. Let's say you look at a company and you think, well, fair value of this company should be right around $100 per share. And that's what it's trading at currently. Okay, great. But if candidate A wins, they're going to get some government handouts or government contracts or government grants or whatever the case is, right? And that's going to make the value of this company go up by your estimate, let's say to $120 per share. Okay, you've just made 20% profit. That's great, right? What happens if that candidate doesn't win? Okay, is there an equal downside or more downside? Is the company then going to be worth only $80 per share? Are there going to be additional regulations placed upon it? Or is it just going to be that they're not going to get the government handouts? In which case, $100 is $100, and that is fairly priced. but you're not going to get that bump. Same goes even if the preferred candidate does win, but fails to deliver on that campaign promise, whether it's through their own doing, backtracking, or whatever, or Congress isn't on board in the event that it needs to be. That's something to consider as well. Now, you can't always estimate what fair value is accurately. I bet you if you looked at a company and you and I were to calculate, fair value of that particular stock, we'll probably get slightly different numbers because there's different things that we put into the calculation. But that's still something to consider. How much of the current price or of expected future, presidential changes, market changes, whatever the case is already baked into the price. Now, that's if you're looking at particular industries or particular companies. What if you're looking at investing at something much more broadly, an S&P 500 equity fund, right, or a Russell 3000, right? You're basically looking at the entire U.S. market, and certainly that's going to have a lot less individual company risk than you'd see with something that's much more narrowly focused. But you also then have to consider how much of candidate A or candidate B is already baked into the price. And what do I mean by that? Well, let's look at a brief example. Let's say there's two candidates, right? And one is super pro-business, very low taxes on corporations, very low regulations. And the other one is the exact opposite, very high taxes on corporations and very high regulations. So the cost of doing business goes up, right? Obviously, corporations in that scenario, all other things being equal, will have a preference for the candidate with more favorable regulations. Now, the markets tend to go one way or the other depending on public sentiment, right? If people think that candidate A, the pro-business candidate, is going to get in, then they'll likely bid up the stock prices, right? They're willing to pay more for a stock price knowing that it's likely to go up even further. But if the expectation is that candidate B gets in, well, that's a little bit different, right? They would not pay as much for that company knowing that future earnings, which is really the present value of future earnings is what a stock price is. The expectation is that that's going to be lower in the future, so I'm not going to pay as much for it today. That's something to consider. And keep in mind, you could be wrong because projections have been wrong in the past. And right now they're kind of saying, candidate A and candidate B, the current ones, right? It's about 50-50. So, and neither is as pro-business or as anti-business as the ones in my extreme example, but it's still something to consider, right? How much is President A or President B's candidacy and future presidency already baked into the price? If everybody expects the pro-business candidate to get in, then prices are going to be higher. And if actually candidate B, the anti-business candidate, gets in, then that's going to cause a big pullback in the markets. The opposite is true, right? If everybody expects candidate B to get in, prices for stocks are probably going to be depressed now, expecting their candidacy to come out victorious in November and eventually take on the presidency in January of 2025. But if those projections were wrong, and the pro-business candidate actually gets in, what happens is stock prices are then going to jump. Okay, that's something to consider as well. Another thing to think about very seriously is what time period are you going to be investing in? If you're looking to make a quick buck based on your projections that Kamala Harris or Donald Trump is going to win the presidency this year, there are better ways of doing that than investing in the stock market. In fact, there's all kinds of betting sites out there that allow you to bet directly on the presidential election outcome. I wouldn't do it indirectly through investing in stocks. That seems a little bit crazy to me. Also, if you're trying to make money in the short term betting on things like that, then I would consider that more speculation than I would investing. And I would kind of wash my hands of it. I would say, listen, you do what you're going to do, but I'm not going to be part of this. Investing in the long term is really where it's at because any kind of shorter term market fluctuations up or down tend to get washed out with time. And that's what we want to have happen. So if you are looking at a 10, 20, 30, 40 year or longer time period with your investment, then whether you invest today or whether you invest in a month from now matters a whole lot less. And if you're looking to make it matter even less than that, to mitigate that, specific time period risk of investing October 10th or October, 30th or November 5th, then here's something that you can do, right? You can dollar cost average. You can put part of your money in now. You can put another part in closer to the election, and then you can put more money in immediately following the election, and then maybe a month after, for the last quarter, something like that. That's a better way of investing rather than trying to time the markets, which is difficult in a best case scenario. And now you're also trying to time and predict presidential elections, which are difficult in and of themselves. Last thing I'd like to talk about here is how much is it that you're investing? Okay, if you've got $1 million invested and you're worried about investing $1,000, it doesn't matter. Okay, because even if the market shift 15 or 20%, right, one way or another, which is unlikely, but it's not impossible. I'm not going to say it isn't going to happen or it can't happen. It certainly could potentially. But when you have that kind of a scenario, right? Well, the amount that you're thinking of investing is negligible relative to how much you've already got invested. And if you've got a large chunk invested, well, then that's a lot more prone to, movement than the 20 or 30 bucks that you might lose on $1,000 investment or $100 investment, whatever small amount is. Small is relative to everybody, right? Small for one person might be $1,000, but for another person, $1,000 might be a big investment if that's where they're just starting out. And if you're just starting out, I would caution you to not just invest once and then forget about it. Set something up that allows you to dollar cost average over time. So you're making investments regularly on a weekly basis, bi-weekly basis, monthly basis, quarterly basis, whatever the case is. And over time, those ups and downs kind of end up getting smoothed out a little bit. So hopefully you can appreciate that a question such as, well, should I wait now or should I wait until after the election to invest? It's not as simple as saying yes or no, depending on, who the candidates are that are running. There's a lot of other factors to consider. Some are in your control, others are less so in your control, others are entirely out of your control. And, you should take all of that into effect holistically when you're making these decisions. Generally, it's not a great idea to invest large chunks, and large, again, is relative to you. In lump sums, unless you won the lottery or something like that. I'm sure there's exceptions other than that we could come up with. But generally, you want to invest slowly, steadily over time so that fluctuations in the short term actually get washed out. So that's the long-winded answer to whether or not you should invest now or wait until after the election when things calm down. It depends, right? It depends on a lot of factors. We've covered some of them. I'm sure this isn't an exhaustive list. This is just off the top of my head. If you want to see more videos like this, please hit the subscribe button, give the video a thumbs up, and remember, it's not red or blue that ultimately matters. It's green. Talk to you guys next time.